There's a famous quote from James Carville.
I used to think that if there was reincarnation, I wanted to come back as the president or the pope or as a 400 baseball hitter, but now I'd like to come back as the bond market. You can intimidate everybody.
The bond market. It's one of the most important markets in the world. It's where the cost of money is determined for governments, corporations, and consumers. And it's been screaming lately. But why? Well, for a few reasons. Bonds are a lens into a few different things. Number 1, the economy. Number 2, central bank expectations. And number 3, fiscal policy decision making. Number 1, the economy. The economy isn't great. Inflation is still raging, despite some signs of slowing down. And during bad economic times, bonds are normally a haven, because they pay a fixed rate of interest, stable. But because of the pervasiveness and the persistence of inflation, they aren't as stable. Fixed payments turn less valuable as inflation eats away at them. But that's what inflationary regimes do. They eat away at everything, bonds and stocks. So TINA was the narrative for a while. There is no alternative to the returns that stocks provided. But now, as the Fed raises rates, bonds theoretically have less risk and essentially the same return with yields as same as stock dividend yields. Bonds are not only the alternative, but maybe even the choice. But bonds are also a giant prediction market on central banks. When the Fed is expected to raise rates, the treasury market moves to reflect that. And that impacts all other rates in the economy, mortgage rates, auto loans, etc. The bond market is a reflection of central bank credibility and shows how much markets believe what policymakers are saying. However, the bond market is also a judge on fiscal policy. There's this thing, bond vigilantes, a theory that investors no longer want to lend to governments on the cheap. Rather, they want governments to be fiscally prudent. Liquidity is a privilege, not a right, as B of A says. It's a theory, but the UK saw this play out up close, with markets punishing Liz Truss for the mini budget. The market has become the decision maker in what policies actually go through, and markets might demand austerity in inflationary times, as we saw in the UK, which creates three players: fiscal policymakers, central bankers, and the markets. And in a time when credibility is everything, these three things are increasingly intertwined. Throw inflation and currency woes into the mix, and the line between everything gets blurry. Central banks can definitely throw down the hammer, but if policy creates a revolt in the markets like we saw in the 2019 repo crisis and in the UK just now, who really wins?